Okay. Good morning, everyone. Welcome again to our quarterly strategy. Obviously, this is I think our second time second time doing it or third time doing it by webinar. So anyway, we'll just start. As you know, we released our fourth quarter strategy report. Again, we tried to make it an easy read, but basically, in a nutshell, what we see is that economic conditions, be it Singapore or globally, have bottomed, but we just think that it will be a slow grind or slow climb upwards. I think that will probably be the nutshell for the whole economic situation. Again, this is the usual disclaimer, everything is our own view, and we rely on a lot of public sources, which sometimes we cannot really ascertain the accuracy of these public sources. And our views can change even past this this presentation. Okay, I'll move on to the agenda. So we probably have like 1.5 hours to run through this agenda, and hopefully we can do another 30 minutes of Q&A. During the last webinar, there were still a lot of questions that were not answered, so we apologize for that. And what we'll do this time around, we'll compile all the questions and we will try to post it on our Stocks BNB website. As you know, Stocks BNB is where we park all our equity research, even bond research, and research from some of our offices in Hong Kong and even Indonesia. So I'll just quickly run through. Okay, anyway, as usual, we will just start with just a review of what happened in the third quarter. Very quickly, just 2 slides on this. We do not want to dwell too much on what happened. This is already over. Okay, anyway, just to have a quick look. The column on the left, STI, so this is Straits Times Index, how it performed. I must say it was another tough quarter for us. I think the STI was down 2.7%, and year to date, these are US dollar numbers, so it will be a bit different from what you see. I think in Sing dollar we were down about 23, but this year was another tough year, and you can see we even underperformed bonds. So you can see bonds were up year to date 5.3%. Obviously, the star performer in green this year has been gold, about almost 24%, and again, this is another year where we lost out. If you look under S-REIT, sorry to jump around, the S-REIT column, so that's a Singapore REIT index. So as you can see, this is another consecutive year. I think like 2019, the last 4 to 5 years, we've consistently, the STI at least, consistently underperformed the REIT index. And again, this year, at least the third quarter, was up. The one in the middle is just the MSCI Asia ex-Japan, which is, as we mentioned before, almost all the best names and tech names in Asia, including Alibaba and so forth, Tencent. So that's why the heavy tech-centric names have outperformed. And of course, the US, despite the outbreak, I think at least this year they're up like 4.1%. In terms of how the STI component stocks, as you know, the STI component stocks, there are 30 names or 30 corporates in there. Only 10 were up this quarter. So 2/3 of the index was down, all in the red. So just to give you a flavor of some of the stocks that didn't do well. So the first chart on the left, which are the banks. The banks were actually doing pretty well, and the reason why we liked the banks was because the dividends we thought was resilient, and the dividends actually stood out compared to most countries in the region or even globally. But of course, we know what happened. Somebody decided to kneecap all the dividends. So as you know, dividends for this year will be limited to up to 60% of last year. The REITs actually did well, and what was impressive was actually the industrial REITs was the one that performed well. As you can see, most of these are industrial. The big name, the one on the right, the restructuring and resilience. So these are the biggest gainers on the STI. Sembcorp, we know what happened. So it was a restructuring, and the rest were just resilient. Despite the economic headwinds, they still expected to perform well. The one at the bottom, so the worst performers were on the left. So of course, we know what happened. We call it pandemic-related weakness. I guess Temasek withdrew the offer. I mean, the reason given was the pandemic-related weakness in operations. Then, of course, the rest were also affected by the pandemic. The one in the middle is just the property, and the one on the right is just the consumer sector. Again, the consumer names were also affected by the lockdowns. We'll elaborate more on Thai Bev, but as you know, there was a 3-week shutdown of any alcohol consumption in Thailand. So as a result, it also affected the share price performance. Okay, anyway, that's it for the review. We don't want to delve too long. So in terms of economic conditions that we are expecting, just to give some context of how is the economic growth globally. We usually don't like to talk much about GDP because you can't do, even with GDP, information about GDP, there is nothing actionable about it. But anyway, just to give you a flavor of how weak the global economies are. So these are the World Bank numbers. So as you can see, the one in the bar in red, this is the weakest since the global financial crisis, which I thought, the impact on the ground wasn't that bad, but you can see from the numbers here globally, we are declining not even 2 or 3 times more than during the global financial crisis. They have quite an optimistic outlook, I guess, for the 2021. Okay, the next thing is we do see a sharp rebound, a V-shaped rebound. But what from our perspective at least, PMIs are more like a momentum. They look at month on month, how does this month look compared to the prior month. So these are more month-on-month recovery, and even though there's a V shape, but this is from total shutdown to total reopening. So you will typically get this kind of V shape. But what we worry about is mainly the year-on-year numbers, which we still see year-on-year weakness across many of the sectors, at least in Singapore context. Move on to the next slide. This is an interesting data point that we get from Google. So they actually measure this daily. They used to have more, actually. They will measure how is the activity in supermarkets, in shopping malls, and so forth. But I think because of confidentiality reasons, I think they decided not to give daily. But this is the only one that we get from daily. So basically, just to give you some sense of the amount of people going back to office. So you can say that we are roughly maybe 80% of workers are only back to office, and its activity has not fully resumed in Singapore. Okay, this is just my last chart on the economic conditions. For us, economic conditions can just be summarized, and we say after the quick snapback when the lockdown is removed, then we are just doing a slow grind. This is just one quick chart and how the impact of the stimulus. As you know, the US spent almost 3 trillion plus on their stimulus. The stimulus, they call it the CARES Act. So from this, you can see, quite amazing. The US gives a lot of economic data. So what they do is they actually measure the disposable income. So they measure your income less how much you pay for tax for individuals and also the small business sole proprietorships. So what you can see from this chart, at least the blue chart, because of the stimulus, the consumer or households actually didn't see any drop in the income because of the one-off payments, something similar to what we got here in Singapore. You also have unemployment benefits, which is like which you get an additional $600 a week. So in fact, the US households' income actually rose. You can see from the blue chart. In April, it actually rose. But if you take out all this support, you can see that the income for households actually dropped, the one in red. So the message here is just that you have not really seen the weakness, the economic weakness yet because of the government stimulus. So what we worry about, if you follow the US market closely, there's another proposed stimulus, of between 1 to 2 trillion. So if this stimulus doesn't happen, you can see that red line beginning to wane off again. So that's what we worry about, the full impact of the COVID weakness on global economies, at least in the US and probably globally, has not really been felt yet because of all the stimulus. So we also worry that the other part we worry about, as the stimulus wanes, the economic momentum might slow down again. Okay, anyway, that was the economy. So now we just want to move on. Some key themes that investors should be watching, or some key themes that are underway in the global economy. So any theme number one, so this chart is the global pandemic, COVID-19 pandemic. These are new cases that's happening, and this is a weekly average. So what you can observe here is on the blue line. So what it basically says is that we are struggling to contain the pandemic. In March, we thought this thing could be arrested maybe more in 3 months or hopefully even in 6 months. But you can see this thing still continues to climb to record numbers. So the blue line are the global numbers. And some of the reasons why the global numbers continue to touch new highs is we're getting second waves, which are even higher. So if you look at the red line, which is the Europe, So you can see Europe actually managed to contain it in June, July during summer. But right now it's surging back up again to even levels higher than in March or April. Then the beige line or orange line is the US. They got a second big wave, and right now, hopefully they are managing to contain it so that you don't get another peak levels. So just a reminder, second waves do occur. So these are all the European numbers. You can see in UK, they managed to control it. The red line managed to control it in March, April, May. But I think they relaxed the rules, and you can see there's another wave. So the key thing, and of course France, I mean, it's like hitting another all-time peak or even higher. So the key message here is that if this thing doesn't get contained, there's more risk to the global economies. If this is not contained, what it means is, as you all know, there'll be more lockdowns, the reimposition of lockdowns, like what we see in UK and even France on certain cities. So that is the other worry we have on global economies. But the good news or very good news is Singapore. So if you look at this chart, the blue line is basically just the daily numbers, but you know it's better to look at the weekly numbers. So these are just community cases in Singapore. If you just eyeball the red line, which is the average, so as you can see, when we went into the really heavy circuit breaker, the number of cases we had on, actually the missing there is 7 April, sorry, the number of cases we had was almost 50 on average a day, community cases. Then phase one we relaxed because it was 5, then 7, but right now we have 0 sometimes, and most have 1 community case on average. So the message here, or the key point here, is that the good thing is that we are managing it well, and we should expect more easing in terms of good gatherings, and we have seen, and also hopefully more green lanes and so forth. Okay, anyway, we move on to the second theme. Sorry, the chart is a bit blurred because this is what the Fed gives out. I'm not sure why they can't give us a better looking chart, since the whole world kind of uses this chart. But anyway, the second theme is that the Federal Reserve is basically promising all of us that there'll be low interest rates until 2023. So for the not 2021, 22, 23, you can expect the next 3 years, assuming conditions remain the same or even move along their so-called forecast, they are not expecting any rate increase. So the way to read this chart, just in case some who don't know, so there are like 12 federal governors, Federal Reserve governors, and maybe I think only now about 5 Federal Reserve board members. So all of them will vote. So they give you a vote and say, okay, how do you think interest rates will be in 2023, 2022? So as you can see from the blue little dots, sorry if some using mobile phone they can't see, but you can see that most of these Federal Reserve officials are expecting no rate increase. So most of them, you can see, I'm not sure who is the outlier, probably the one that's most unpopular in 2023 decided to say that there's going to be a rate hike. But anyway, most of them are not expecting any rate increase, probably only in 2024 onwards. So as a result, as you know, this is important because the Federal Reserve will drive global interest rates. So, the other theme here, what we're trying to say is that there'll be low interest rates for the next at least 2 to 3 years based on the current trajectory of economic conditions. Okay, and just a bit more economic centric. So I mean, if you want, you can shut your ears. It's fine. So what the Federal Reserve will also say that what will make them move their interest rates. So basically, there are 2 conditions. This is the PCE. That's another way of calculating inflation. So the 2 things that will only make the Federal Reserve raise rates is, number 1, inflation, or there must be above, these are their words, these are not my words, moderately above 2% and for some time. Don't ask me what is for some time, actually they never define it. So so from the chart, what you see is that what must move is the blue line. The inflation rate must cross the red line, and you must stay above it for some time. So until that happens, there will be no risk of them raising rates, and also they want maximum employment. I think right now the latest number, as we all know, unemployment in maximum unemployment rate in the US now is about 7.9%. So we are still far from these conditions. So what we have to do is every month just check and hope or maybe even pray that this blue line doesn't cross the red line. Then we have there's a risk of interest rates being increased, and obviously any risk of rate hike will of course affect the market. So anyway, for us, we will just have to monitor this every month diligently, I guess. But I mean, this is probably the most important indicator of future interest rates. Okay, the other theme that we see is the vaccine is likely coming soon. Of course, there's no medical background for me to say this, but I think just two reasons why we say that. Firstly, if you look at the number, like 3 quarters ago, a quarter ago when we did this, this is all compiled by the New York Times. Phase 3, which is basically the last stage of testing before approval, there were only 5 names in the phase 3. So right now we have about 11 names. So number one, so there are more companies in phase 3. The other reason is that what has happened is that in a typical, when you want to get the typical vaccine route, as you can see from the bullet point, is usually 5 to 10 years, and more important, it costs almost 500 to 1.5 billion, and the failure rate is 93%. So basically, out of 10 that goes in, only 1 approved, and who's going to bet like 500 million to 1 billion with this kind of odds? So what has happened is that the US has done, I think probably one of the better things that they have done is this thing called Operation Warp Speed. So what they do is, let's say you pick a name, the Moderna, okay, the one that's all over the news. So what they'll tell Moderna is, I'll give you 1.6 billion to kind of buy your all like 100 million doses or so forth. So I'll give you this money, you can take it and try and develop. So the second reason why the vaccine is likely is also, it kind of de-risks the whole vaccine discovery route. So, I mean, if you're a company, are you going to risk 500 to 1.5 billion and you're not even sure? So at least this time around, the government is willing to fund you. I mean, if it doesn't work out, then it doesn't work out, but you're already getting pre-funding for the development of your vaccine. And I think they're spending already spent about 10 billion on this. So the chance of approval that little dot there is high. And if you just want to know who are the names, so these are the names that are in the phase 3 and limited use. Of course, the famous one is the Russian one. I think Gamaleya, as you know, that's the Sputnik. I think Sputnik 4 or 5. I know that's the one that Putin says is the vaccine that they have. Okay, and this is the other thing to watch. As you all know, if a vaccine really is approved, then of course the market can rally. The other team, I think I won't delve too much on this, is the US election. I think my colleague Chun Rong later on will have a very elaborate and very detailed explanation on the presidential. But at least for us, as you know, we are covering Singapore, and so for us, Biden win basically means it will be positive for not only Singapore, it will be positive for Asian assets and Asian currencies. It is just a general comment. The chart here is just what we do is we monitor how the people who like to bet. I mean, you can actually bet who's the winner. So these are the odds. This is only up to 16 September. So I think obviously with what has happened the last couple of days, and maybe the odds would have increased. So the odds at that time, like 2 tricks, were about 56, 57% of chance of Biden winning. Okay, anyway, this is the final theme. We actually just wrote a bit about this in our Singapore strategy. Basically, our point here is that equities is still the best option for investors like all of us. So this chart basically measures the dividend yield against, if you put money in a DBS time deposit. So what it means is that if you rather, let's say, buy a bank and you get like 4% yield or 3% plus versus putting your money into 12-month deposit, which I don't know, is 20 basis points or 0.2% or some along those lines. So our point here is that the dividend yield that you get by putting money into equities is one of the highest since the global financial crisis. You can see in between the 2014, 2017, the 2016, there's a big spike there. As you recall, this was during the 2016 when all the banks had all the oil and gas problems. So that was one of the reasons. But since then, what we are trying to say is that by putting money into equities, not only do you get a better yield, and also don't forget that the dividend yield can grow. I mean, this is a bit theoretical. So what it means is that whenever a corporate pays you dividend, they're not giving you all their money. They're not dividend out all their earnings as dividends. So most of them probably pay out 45%. So the other 55 actually can grow So your dividends not only are higher, but your dividends can grow compared to what you get in, I guess, if you're stuck in with deposits and with interest rates being low for possibly the next 2 to 3 years. And the other thing is that these are probably the dividend yield forecast, and this I think incorporates, as you know, what has happened. The banks are kept in the dividend, so the dividends are also kind of artificially suppressed because of what has happened, because of authorities asking the banks not to move their dividends. Okay. Anyway, I will move on to our. So the next couple of slides, we'll just quickly rush. We'll just run through what are our basic sector views. Then we'll have our stock picks. I'll move on to Terence, our utilities analyst and conglomerate analyst. Terence, over to you.
Thanks, Paul, and good morning, everyone. In the utility segment, we have seen a recovery in electricity tariff prices in India and China from the faster than expected pickup in economic activity in India and China. So you can actually see this on the charts on the left. You can see India industrial production electricity index, despite declining, you see a very sharp decline here in the first half of 2020. The first quarter of 2020 rather, electricity consumption actually started to increase very, very sharply again from June to July. And China electricity consumption change that's also declined in the early half of 2020, but has also seen a recovery. So with this improvement in electricity consumption, we have actually seen average plant load factors. So plant load factors are the plant, it's like the plant utilization rate has recovered to about 60 to 65% capacity in India and China versus the pre-COVID-19 levels of about 75 to 78%. And you can see that the PMI numbers have also improved. In India and China, both improving to 56.8 and 51.5 respectively in September. And this is again an improvement from 52.0 and 51.0 respectively in August. So we have a overweight rating on this sector, and our preferred pick is Sembcorp Industries. More on this later. I'll now pass on to Wee Guang, our banking analyst, to cover the banking sector. Wee Guang, to you.
Thank you, Terence. Okay, so now moving on to the banking sector, I think the sector will continue to be hit by some macroeconomic headwinds, including the low interest rates and the dismal loans growth. So on the left-hand side, you can see that the graph actually shows how far the SIBOR and the SOR has fallen since the start of the year, and how the net interest margins have followed suit in the table below. So when we compare the average rates over the past quarter, so even against just the first half of this year, which is shown in the table on the bottom left, we can see that actually the rates are about 60 to 70 basis points lower than what we observed throughout the first half. So we think that the net interest margins for the banks will probably be going to continue experiencing some pressure for a while more. And on the right-hand side, in terms of the loans growth, latest August loans growth data actually show that both business and consumer loans actually contracted year on year. And looking at the red line, which kind of shows the total loans growth, we see that apart from 2015 to 2016, even during the global financial crisis in 2009 and 2010, right, total loans growth was better, although business loans took a hit during previously in the global financial crisis. However, what we are observing is that the good thing for the loans part is that month on month, we see that consumer loans are actually starting to recover when we exited the circuit breaker in June. So apart from housing loans, we see that credit card loans, car loans have all started to recover month to month. But in the fact that loans growth has been so slow is something that will hurt the banking industry. Next. Okay, so moving on to the next sector for healthcare, we do see some recovery in the patient visitations for the private healthcare sector. But as you can see on the graph on the left, right, across private hospital, dental clinics, and specialist outpatient clinics, the recovery is quite uneven. Visits to the dentist is still down about 40% year on year, and this is based on a 3-month moving average number. And while hospital and specialist visits are back up only about 80% of pre-COVID-19 levels. Nevertheless, with foreign patients making up 20% of a typical patient load, we do expect the recovery from here on out to taper until we see maybe travel restrictions are lifted and we can have some foreign foreign patients coming in again. So the impact will be quite large because for these hospitals, they are losing a portion of their revenue from these foreign patients, as well as usually the foreign patients usually are higher margins business for them. However, we did speak to a few companies, and they did mention that the locals are actually visiting these private hospitals more post this circuit breaker period. But it might be due to a pent-up demand after the circuit breaker. So everybody started to take on all their electives procedure as well. And moving forward, the next trends of the telemedicine may also be on the minds of a lot of investors. But generally, most players feel that telemedicine is not really like a disruptor. It's more like a new service that is complementary and will only start to only starting to evolve alongside the entire industry. So now moving on, I'll pass time on to Natalie to talk about the property sector.
Okay. Hi, good morning, everyone. So jumping right into property, things look relatively optimistic for the property sector. Prices are holding up well. The graph on the left is the red line shows the property price index, which was up about 0.7% year on year in 3Q. This is 0.2 percentage points higher than the peak in December 2019. So developers are making good headway, chipping away at the number of unsold units, which is the blue line here, which is down by about 17% year on year to about 28,000 units. So this actually reduces the overhang of unsold inventory. In the graph on the right, it shows the monthly new residential sales. So primary home sales turned negative in the months of April and May during the circuit breaker. As you can see, the red line broke below the black line and has since recovered strongly, transacting at almost 1,000 units a month since. So year to date, we are about 74% of 2019's sales numbers of about 9,900 units last year. Next slide, please. So we believe that property prices will be well supported because of these reasons. So first of all, of course, the GLS, there's a relatively low amount of, the government has kept the GLS supply on the confirmed list relatively low at about 20% of the actual supply. Interest rates have also dipped lower, and this might actually spur home sales or encourage upgraders. The stabilizing policies like the deferment of loan payment and extensions will help any real buyers who are sincere buyers, especially from preventing them from withdrawing their OTP. Also, the higher land prices in the past few years, as developers actually build up their land bank, actually prevents them from offering deep discounts on new property sales. So this actually helps to keep the pricing stable. And overall, we actually noticed that there's a strong household balance sheet pre-COVID. So in terms of loan to value, it has actually fallen over the years from 53% to 49% over the past 2 years. Next slide, please. Next slide, please. Thank you. Okay. For now, moving into the office subsector. So we believe that the office subsector is currently in a sweet spot due to the resilience of the office using tenants, the continued relevance of office, and the demand and supply macro factors. So in comparison to other industries, the office using sectors have been comparatively more resilient, and we believe that the office workspace will remain relevant due to the value added by mentorship, collaboration, corporate culture, and creativity, which are best effected through physical interaction. Demand drivers for space arises from social distancing requirements, such as the lower desk densities in offices and split offices, and Singapore's attractiveness as a regional base for both Western and more tech, such as ByteDance, Alibaba, and most recently TikTok. And the need for companies to maintain the same footprint and the same number of desks despite allowing for flexible work arrangements. Supply conditions are supportive, with an average of 0.9 million square feet expected per year, and this is below the 5-year average of 1 million square feet. This is before AXA, Fuji Xerox Towers, and Central Malls. Yeah, so this these three assets will actually take off almost 1.2 million square feet of supply, help further support. Next slide, please. Okay, now on to the retail subsector. So post-COVID, we see that e-commerce penetration has indeed increased. It has doubled. Post-COVID has indeed increased. It has doubled to be exact. However, we find that the e-commerce is best suited for people who prefer price comparisons, non-urgent, discretionary kind of purchases, and good to have purchases. So it is easy to list anything online via e-commerce platforms like Lazada, Shopee, Amazon. However, in the long run, e-commerce competition will get stiffer, and we believe that having an omni-channel presence will be the differentiating factor. So brick and mortar stores are important as it allows for better branding through differentiation and experiential aspects, building awareness and visibility, quality confirmation, and we believe that these factors will help to drive brand loyalty and ensure longevity and survivability in the retail business. So additionally, we also noticed that operators, larger operators like your Frasers and your CapitaLand, they have started focusing on driving customer and tenant stickiness. This is primarily done through their digital ecosystem of loyalty, the loyalty program, as well as their online e-commerce platforms like your food ordering platforms and your e-commerce platforms. So without going too deep into this, basically it's similar to how we have, this is similar to how we have, or rather we have loyalties towards certain bank cards and, you know, for example, your KrisFlyer, your Citibank card. And this is similar concept where it encourages consumers to actually amalgamate or consolidate their purchases on a certain platform. So in this case, it would be from malls. Yeah. Okay. I'm getting some comments here. Okay, sorry. Next slide, please. By the way, the source for the online sales is actually from SingStack. Okay, so moving on to the hospitality sector. So this is largely a waiting game, and we're waiting on a vaccine. We expect the pre-COVID recovery to actually, the recovery to pre-COVID prices to come in only in 2021. So this is a more conservative aspect. While we do expect, we expect the recovery to pre-COVID levels to actually come in 2022, not 2021. So 2021, of course, there will be an uptick, especially with the opening of borders post-vaccine. However, the full recovery will only come in 2022, sorry. So of course, it has been a few months since the start of quarantine, about seven months, and the quarantine business is falling off. So this quarantine business, block bookings from the government has actually been helping to shore up occupancies for some of our hotels in Singapore. Of course, on the positive side, the fast lane agreements for essential travel have already taken place, and they are in place for about 5 countries, and this will slowly, gradually help to return the corporate travelers back to Singapore. And the allowing of hoteliers to actually open up and take staycation business will help marginally, help the hoteliers marginally. So we believe that Singapore will likely be one of the first countries to welcome leisure travel, given the very low and sustained case counts in the community. So for FY20, master leases are generally the revenue that is actually popping up rents. Next slide, please. So moving on to the industrial subsector, things look relatively resilient for the industrial sector. There were some bright spots, namely logistics and data centers. The green line in the graph shows the slight uptick in the warehouse occupancy. So during the lockdown, industrial REITs actually benefited from new leases due to stockpiling. And going forward, we can expect higher stockpiling levels to be maintained. There was also some expansion and new take-up from 3PLs, which are your last mile delivery services. However, we note that actually the main driver for logistics in Singapore is that it comes from contract manufacturing. Data centers are also beneficiaries of the pandemic. So in the graph on the right, we can see that flat and they have been bottom. So not much change there. And supply is relatively muted for the industrial sector, coming mostly from the light industrial asset class. As you can see in the bottom right graph, the light industrial sector is highlighted, is the light blue bar columns. So most of the supply is actually coming from there, and they are on a pre-committed basis, or rather a large portion of the supply is actually pre-committed or built to suit supply. And for the other asset classes like your business parks as well as your high-tech assets, supply is actually very low. Next slide, please. So this is a wrap-up slide. Basically, we are overweight on REITs, and we think that the low interest rate environment will be conducive for REITs. As you can see in the graph on the left, we have twinning arrows. So every time you see the interest rate fall, which is your darker blue line, it falls. It results in a spike in the FTSE REIT index. So we can see this relationship is an inverse relationship between interest rates as well as the price performance of REITs. And moving on to the graph on the right, we can see that actually the REITs have outperformed the STI in periods where of low interest rates. So the periods of low interest rate are actually highlighted by the shaded areas in blue. So you can see the outperformance of the REITs over the STI. So with the recovery in share prices and this conducive interest rate environment, the REITs are expected to outperform again, largely driven by acquisitions. So that's all for me, and I'll pass the time on to.
Thanks, Natalie. So I'll just run through the remaining slides on all the other sectors. Some sectors we may not cover, but we just tell you what does the data point say. So we'll just start off with telco. So I'm the analyst for telcos. I'll just refer you firstly on the chart. I know it's a very, very noisy chart, not easy to comprehend, but basically this is the chart of the postpaid selling prices. So these are the prices where every month all of us pay to our mobile operators. So during, like, if you look at from 2008 to 2016, the prices were pretty stable. Of course, for Singtel it came off somewhat, but for StarHub, you can see that the selling price for the monthly selling price of their mobile services was stable around 70 to 75 $75 to $70 per month, and we call this the happy days, and because there was probably minimal competition, and also what has happened is that it also helped the share price, and that's why it did so well during this time. But as you can see, prices started to fall from 2016. Actually, it's like end 2016. And 2017, that's where you got the full impact of the decline. So what has happened is that it's no coincidence that in December, as you can see under the source, 14 December, TPG was awarded the 4th license. So what the operators did was that before TPG come in, you just have to lower the price. So what you want to do is to shrink the profit pool at least available for TPG, which was going to be the 4th mobile operator. So anyway, I'll just move on to the bullet points. So what has happened right now is that the telcos are weak, the share prices are weak. I saw a question there, partly because of roaming. You can see the price there again, the word roaming. So prices were beginning to stable, maybe around 39. I mean, of course, there will be also some impact where some of our phones now we don't get the phone subsidy, we just buy the SIM only. So there also a impact. But what we saw is there was a big decline in ARPU, the selling price, and it took to, as you can see, it's an all-time low, and partly because roaming disappeared. So 20% of, let's say, Singtel's mobile phone revenue actually comes from roaming. So when I say roaming, again, for just those who may not know, so what it means is that whenever we go overseas, go to Malaysia or China, we roam there. And for those who come in, the tourists that come in, actually that's probably the highest margin business because it's on their network. So 20% just disappear. As we all know, the borders just shut down, and these are really high margin business. I mean, when the tourists come in, you're not going to spend a single dollar extra for them, right? They're just going to tap on your network, and it's virtually pure profit for them. So what has happened is that they lost their revenue. So that is affecting both StarHub and Singtel. And then for Singtel has an additional problem. It's more an Australia problem, which is Optus. I think a bit more complex to explain, but what has happened is that Singtel used to offer, or Optus seems to offer cable. It used to be like the StarHub, to make it easy. They used to like offer cable broadband to all the households, but then the government said, like, what happened here? You don't offer your cables anymore. We will offer our Netlink equivalent. So what has happened is that it killed the margins for Singtel. It basically hurt them because they used to have a lot of operating leverage. They used to have very high margins when they sold their cable broadband. So that's the one problem they had in Australia. Then the second thing, just to make the situation worse, as you transition from cable to this new fiber, you still have to carry the cost until all your customers leave the network and go to fiber. Then now you have to bear costs. You not only lost the margins from as customers go to fiber, then you also lose because you have to maintain your existing cable network. So it's quite a sad story actually. But anyway, then what's happening is as you know, Singtel also owns Indonesian, Thailand, and what's happened is that in a weak economic scenario, a typical mobile phone user in, let's say, Indonesia or Thailand, they're not like us where we just pay monthly. For them, they will pay as you go. So if I want to use $10, I'll just pay $10. Then maybe I use $5 if I have the cash. So of course, when the economy is weak, then they obviously cannot spend so much. So because they don't have like a monthly recurrent, because it's more on a prepaid basis. Just one bullet point. I mean, this is nothing to do with the investment thesis, just to give you an update on 5G. So the 5G right now, at least, will be a very niche offering. It's not going to move the needle. And I think all the telcos are just going to try to roll it out slowly and try to find a better use case for it. I mean, right now, you only want to use 5G if you want to game faster. And I mean, only what it does is only increase the speed. I guess you can always just wait 1 or 2 seconds more to get the faster speed. So anyway, for us, for telcos, we have a neutral call. One thing to watch for a turnaround is, if the international borders start to open, then that 20% of revenue can recover, and they can at least help the telcos, namely for StarHub, because Singtel will still have a tough time in Australia because of Optus. Okay, and then we move on to aviation. Again, we don't cover aviation, but just to give you the latest data point. I mean, not to make a joke out of it, obviously it's a very serious thing where there are job losses, but actually we don't see any green or even bean sprouts or any green shoots or any green spots here. So things are still really weak. You can see before the whole COVID pandemic, I think SIA carried roughly around almost 2 million passengers a month. But right now it's only 24,000. So it's like 99.999 kind of decline. And that's one of the reasons that I'll address later why we have a sell call on sets. The return will be long. It will take a few years, and the reason why we put that staying alive till 2023, because these are the forecasts given by Boeing, by all the international airlines of when a recovery and the IATA. So some of them are looking at 2023, 2024. Of course, these are still forecasts, but any full recovery will take at least 2 to 3 years away, and like we showed before last time, even during 9/11, it took 2 years for passengers to recover, and with this kind of pandemic, we think at least 3 years or even 4 years for recovery. And you can see the numbers are still obviously quite dire because the borders are still closed. We move on to land transport. I think land transport is basically just ComfortDelGro. Why we like it, and we'll explain it later, is for us, compared to airlines, you're going to get an immediate lift from them. So for us, Comfort is going to be the immediate beneficiary of the easing of the lockdowns. As in Singapore, as more people go back to office, more gatherings. So what you see is that there'll be more travel to work, more travel to meetings, not to prayers, to classes. Actually, these are the events that can help, because right now the number of the traffic or travel by taxi is big, because not many people going to work or meetings. Prayers are closed, classes are closed. So when these things start to unravel, we will see the pickup. The chart that you see here is basically what is the amount of travel being done by the taxi. We get this from LTA. So what it just tells you that we do see a rebound. But of course, it's nothing to celebrate now. If you see the chart before COVID, we are still far from before COVID. But these are July numbers. So hopefully, as the things start to open up, you can see this chart continue to climb. For those who want to know, this is just a one shift ever monthly kilometer traveled by a typical taxi driver. By typical taxi driver. Okay, anyway, I'll move on to consumer. So this is basically the year-on-year sales by in Singapore. So the red line is a bit hard to see because it's covered by the orange. So the red line is basically supermarket retail sales in Singapore. So obviously with the pandemic, it totally just collapsed. Retail sales used to move in Singapore maybe 1%, 2%, as you can see from 2010 to 20. So when the pandemic hit, the whole thing just collapsed to, it declined to almost as low as 30%. But what you see is the blue line. So the blue line, you can call this blue line the Sheng Siong line, because it's supermarket sales. But the more tremendous thing is actually Sheng Siong typically grow even faster than the blue line. So I think Sheng Siong the results for their third quarter will still be very strong. But obviously, for us, we had a neutral call because of the valuations and post-pandemic, they will still grow, but obviously it won't be this kind of rates. So we just have a neutral for them purely because of valuations. But you can see what consumers are just buying the necessities, and as you can see, everyone is just shopping for the consumer staples. The orange line is other eating places, which I think Terence will elaborate more. This is more like what is being consumed in hawker centers and food courts. Okay, then just to have a peek at construction sector, the blue line is basically those awarded by the public sector, by private developers, by maybe the IR and so forth. So it has definitely taken a tumble. It was initially coming up, but with the whole pandemic, what we see, as you all know, a lot of sites are not ready because there are basically no workers to go on site. So as a result, you see the contracts awarded being declining, and contracts built means the amount of contract work that's being done. So that is also declining. But for us, we are actually a bit more optimistic on this sector. When speaking to contractors, basically what we see is that most of the contracts are actually just deferred. They're not cancelled. Deferred because there's basically all the worker dorms have been shut. And if you want to play the construction, like we mentioned before, the better way is the building materials. The reason why we like building materials rather than construction companies is number one, the building materials, someone like Pan United or BRC, their market shares are huge. I think like Pan United market share is probably like 40%. I think BRC is even higher, probably 70, 80 or more. So that's number one, they have better market share, the building materials. And number two, at least when you buy building materials, you don't have to worry who gets what contract. You don't have to try to be so clever and figure out which contractor gets the contract. Building materials will just, so long as there are contracts out there, they will win because of their huge market share. Move on to the next slide. I think this is going to be my last slide on sector before we go to stock picks. Anyway, for the marine sector, this is your Sembcorp Marine or Keppel Corp. So I need to explain to you the chart. We usually do this and we just update it. So the blue line is basically the order book, the outstanding order book for Keppel Corp and Sembcorp Marine combined. So the sad thing is that even before the whole pandemic, the whole collapse in oil price, the order books were already declining. As you can see, declined from 7.39 billion to 6.8, and based on the first half, it's down even more to 5.4. And the problem we have is the red line. So all capex was actually climbing. I mean, at least stable, but you can see that the order books for them continue to fall even when all capex was down. This all capex basically, what we did is we take all the capital expenditure from all the Chevron, BP, Exxon. We combine all of them, probably like 20 companies or more, and we see what is their expected capex. So you can see that for 2020 it's going to collapse. I think it's down almost 21, and even in 2021, the amount of capex is was only going to be a small increase of 2%. So this weakness in marine, we think, will continue. I mean, based on the capex for at least the next 1 to 2 years. But do not know our capex is the total. So some are upstream, some are downstream. But I think you get the sense that, as you can see, during the good days of 2013, 2014, when all capex was up, obviously both yards benefited. So but right now, I think the outlook is quite grim or weak. I mean, just use the word weak. Sorry, one more chart on technology. I cover the tech sector. So the tech sector, it is on their multiple structural headwinds. There's not enough space to type all of them out. So for the tech sector, of course, in the near term, what you benefit on, as you can see, this is basically the chart of online sales versus brick and mortar sales in the US. So obviously, when the pandemic came out, everybody just moved online to buy. But what happened in the short term is everybody is working from home, gaming from home, spending time from home. So that's the one trend for tech sector. The other sector is that the budget for most individuals have moved. Obviously, there's no tourism, so the budget has moved from services to goods. And because of gaming and with 5G coming up, you're going to see more cloud computing, more edge computing, and mobile computing. And the other benefit of tech sector is what we're going to see is there's a 5G ramp underway. As you know, Singapore is also rolling out 5G. And with 5G, the number of antenna filters will double, triple, or even quadruple. Then, of course, for cars, right now, cars isn't the best thing right now because sales are weak. But as we all know, there's more automation in cars. Now you have driver assist, you have sensors in cars. So the amount of electronics in a typical car continues to rise. And the big one is when you get an electric car. So that will, you need more demand for power, more sensors, more lighting. LED lights also needs a lot of electronics and so forth. Your LiDAR and so on. So all these are structural trends. Of course, we all know there's increased data storage. The final bullet point, maybe more unique for all the the electronic stocks in Singapore and Malaysia, is that there is a supply chain move. We don't really get the announcement here, but if you follow some of the electronic companies in Malaysia, some of the contract manufacturers, they are getting a lot of business as the supply chain. A lot of the US companies are moving their suppliers from China and to Southeast Asia, in a sense that they're looking for suppliers in Southeast Asia. And when we speak to some, I think actually their capacity is full. I think if you go to Johor, I think the capacity is virtually full. So that's the other benefit for venture and any of the contract manufacturers, electronic manufacturers that are based in Malaysia. Okay. Anyway, for us right now, unlike in our previous presentations, we usually just comment on the stock picks for our absolute 10 model portfolio. But right now, we're going to have a run on all our buy calls. I think that will probably be more meaningful for our listeners rather than talk so much about macro. So as you know, we have a model portfolio. If you can't decide on what stock to buy, so this is our model portfolio of all the stocks under our coverage. The changes we did, how to read this is that, so these are the 10 stocks on the left, and we try to break it down to a balance. I mean, we're not going to put like a ultra high growth small cap. I think the only small cap we have, or mid cap, is a Propnex. What we want is a more balanced, more stable portfolio. So we have the yield stocks, then we move on to the dividend growth stocks, then we have growth stocks, and then we have a re-rating place. For those who don't, what I mean by re-rating means, the market will, let's say for instance, ComfortDelGro, they'll re-rate it because things are turning around and so forth. So the changes that we made, we took out Escort REIT. I think because of the second wave in outbreak of the pandemic in Europe, I think any recovery will take a longer time. We took out DBS. As you all know, the dividends just got kneecapped. That's why we replaced it with SGX. And then we took out Venture. Venture is mainly purely for valuation reasons. I think the second half will remain strong, but because of valuation, we just took it out. And then we added in ComfortDelGro. Just one final point on our model portfolio. You can see on the table on the right. So basically, this is just our monthly performance. We obviously beat the STI by 14.7 percentage points. But again, I mean, the reason why we call it absolute is supposed to generate absolute return. So we're not happy with it. I think we obviously outperform, but you know, when you outperform and you lose money, it doesn't pay the bills. So your fund manager tell you outperform, but you still lost money, then okay, you just tell them that it doesn't pay the bill to lose money. So anyway, we will just run through right now all our stock picks, and these are all our buys or accumulate. Accumulate is also a buy, but it's just not the returns are just lower than 20%. I'll move on to Cheh Hui on Roma strategy.
Thanks, Paul. First, we have Yoma. Yoma is a conglomerate in Myanmar. It has 4 key business lines, namely property, F&B, motors, and financial services. The property business is the largest contributor to Yoma's revenue stream. In the property segment, it has a large property land bank that's equivalent to 10 to 15 years of sale. The projects in the pipeline will include the up-and-coming Yoma Central, Star City, and the Peninsula Yangon. Financial services are also poised for growth through its key driver, Wave Money. Just a bit of background, Wave Money is actually profitable, and then it became profitable within 2 years of inception. If you see the chart on the left, its revenue is up by 5 times year-on-year as of March 2020. This is attributable to its brand leadership and a large network of Wave agents in Myanmar. Amidst COVID-19, the over-the-counter transactions were impacted due to lockdown measures. However, its e-wallet business still continued to record double-digit growth rate month-on-month, accelerated by e-commerce. In June, Yoma actually announced an increase in stakeholdings to become a controlling shareholder. This creates opportunities for Yoma to integrate Wave into its existing property and consumer business lines. Lastly, its growth in the F&B segment is also underpinned by a 60% growth in KFC stores over the next 3 years. And this is just on store openings alone, excluding organic growth. Yoma is expecting the number of KFC stores to increase from the current 45 to 75 stores should Myanmar's economy recover. Amidst COVID-19, the F&B stores were hit due to the lack of dine-ins, partially cushioned by delivery sales. The target to open 2 to 3 KFC stores by the end of the year still remains unchanged, but then the openings will depend on the overall market conditions. In conclusion, we like that Yoma is entrenched in Myanmar's fast-growing and attractive consumer segments, and we find current valuations depressed in view of structural growth. We maintain a buy with a target price of 46 cents. Next slide, please. Okay, next we have first sponsor. FSG is a developer, owner, and financier of property projects. Its key revenue contributor comes from property development, and its main operations are in China and Europe. The main thing to note for the property development segment is that Dongguan, the key market that FSG operates in, saw high demand for its properties such that most of its residential projects are sold out shortly after launch. As a result, it owns close to 600 million worth of revenue that has yet to be recognized. Its existing projects also provide for a gross development value of almost 2 billion, which is worth 5 to 6 years of sale. Referring to the picture on the left, the human transit-oriented development project will be one of FSG's largest development projects. FSG owns a 17% stake in this joint venture. Once developed, this site is expected to become a high-speed hub, which will allow for travel to Shenzhen and Hong Kong within a span of 20 and 40 minutes. This development will make the Dongguan property market even more attractive, which is very, very beneficial for FSG's Dongguan's property projects. Lastly, we like the high recurring income coming from the property financing business. Property financing is the most profitable amongst all its business lines, and the loan book is still growing. This double-digit growth in loan book is largely attributable to its high demand for credit amongst the SMEs, and these loans are charged at a low to mid-teens interest rate. In terms of risk, one key risk will be with the hotel portfolio. FSG's hotels are located in the parts of Europe where hotels saw a greater recovery in August, boosted by the demand for staycations. However, Netherlands has seen a resurgence of COVID-19 cases in September, which exceeded its peak in April. We are expecting a stunted recovery for the hotel portfolio till the end of 2020. So in conclusion, we maintain a buy with a target price of $1.65. Next slide, please. Okay, the last slide from me. Next, we have Prime US REIT. Prime's portfolio consists of 12 Class A freehold office properties located in 10 primary markets in the US. There's mainly 3 points to note. On the portfolio management front, we like that there's high income visibility in Prime's portfolio. This is attributable to its high portfolio occupancy and a long WALE with minimal expiries in FY 20 and 21. We also see high levels of diversification underpinned by office-using sectors like finance, legal, and infocom, contributing more than 40% of the portfolio. No property contributes more than 15% to the portfolio's net property income. Additionally, Prime's portfolio is actually well positioned to capture growth. Organic growth will come from the inbuilt rental escalations of approximately 2% for the portfolio. Low gearing levels of 33% provides room for more debt to tap on for future inorganic growth opportunities. Amidst COVID-19, Prime's portfolio remained resilient. Rental collections are at 99% throughout Q2 of 2020, and no rent abatements were given. Only rent deferrals were provided to 8 of their small retail tenants, which contribute 0.2% to their cash rental income. We maintain a buy with a target price of 94 cents. Our forward dividend yield for FY 20 stands at 8.5%. Now I'll pass my time on to Ned, who will talk to you more about Manulife US REIT.
Okay, hi. Moving on to Manulife. So we also have a buy on another US office REIT, which is Manulife. So we like Manulife because its portfolio is protected against short-term uncertainty, and this comes from the long WALEs that are in the portfolio in the portfolio asset. So the WALE is long, is at about 5.7 years. So what this means is that they have longer dated leases, and longer leases typically have rental escalation. So for Manulife, the rental escalation is about 2% per annum. And this longer WALE also actually means that, as you can see in the graph, the first graph, there are very low percentage of leases expiring in FY 20 and FY 21. So it's only about 4% and 6.4% for these 2 years. The second reason why we like Manulife is because of we believe that the office using sectors will remain resilient, and this is because of the comparatively low employment rate for the office using tenants in comparison to other sectors like your service sectors. And also in terms of loan delinquencies, the loan delinquencies for office assets remains low at about 2.2%, and this compares to about 7% for hospitality assets. So we believe in the continued relevance of the office space. So, and this is because physical interaction is viewed as the most effective method for mentoring, collaboration, innovation, and corporate culture. And if you look at the graph on the left, the graph on the right, the Gensler Workplace Survey actually shows that over the years, without the constraint of COVID, we see that collaboration has been on the rise, and it has actually doubled, be it collaborating in person or collaborating virtually. So you can see that actually collaborating in person actually still takes up a larger percentage of the pie. So once again, our rating for Manulife is a buy at a target price of 90 cents. 90 US cents. Next slide, please. Okay, so for our next counter is Fraser Centrepoint Trust, and we like Fraser's because it is powered by necessity spending. So I'm just waiting for a while. Yeah, okay. So for about for Fraser's, because they have a portfolio of suburban assets that are located near the heartland areas with live-in population, and these assets are actually located very near transportation nodes, your MRTs and your bus interchanges. And because of this live-in population, actually a large portion of FCT's tenants are in the essential services trades, your F&B services, supermarkets, health and beauty traders. And yeah, so during the COVID period, we see that this has actually benefited FCT in terms of a large portion of the tenants were actually able, not really a large portion, but about 30% of the tenants were able to operate. FCT's is also primed to benefit from the master plan. So in the number of HDB units surrounding 3 of the largest malls, the graph on the bottom right hand, they are Causeway Point, North Point, and Waterway Point. So these are the three largest malls for FCT. The number of HDB units surrounding these malls are projected to increase relatively substantially. So overall, about 67% jump in the catchment size. So of course, this is a dormant catchment and will actually help to channel some increased sales to FCT as they are one of the dominant suburban malls in the area. Additionally, just a few days ago, 28th of September, FCT actually attained unit holder approval for the acquisition of the remaining stake in PGIM ARF, Asia Retail Fund. So what this does is actually it boosts FCT's suburban retail space NLA by about 80%, making it the second largest suburban retail operator in Singapore. Yeah. So this will actually help to help to grow revenue. So our DPU is actually expected to increase by about 24% year on year due to this acquisition. For the last point for FCT, this is a little bit more far-sighted. So FCT has their own loyalty program in place. It's called Fraser's Experience. So as mentioned from our retail slide, we actually think that this will help to build tenant and customer stickiness, encouraging repeat purchases and shoppers to actually consolidate or amalgamate their purchases within one mall itself. You can buy your groceries, your food, your electronics all at one place and actually be rewarded. So it allows them to compete with your larger scale e-commerce players like Lazada. Yeah. So just a side note, FCT actually disclosed that 1 in 4 of their transactions actually are actually by Fraser members. So just to show you how the impact or the penetration of this Fraser's Experience app. Next slide, please. So the last counter for me for the absolute 10 would be CapitaLand. So we like CapitaLand because of the experience and diversification of CapitaLand. First of all, the diversified real estate portfolio, it comprises retail, commercial, hospitality, residential, as well as industrial. So it actually helps to mitigate against economic cycles. So that's the first point. Second of all, we prefer CapitaLand in terms of as a developer because of the quality recurring income. So for 1H 2020, about 69% of EBIT was actually from investment properties and fee income. So these are recurring in nature. Yeah, just to point out that in the previous year, 1H 2019, actually 90% of EBIT was recurring in nature. So we like this because it provides some sort of stability to even out the lumpy development revenues. So post lifting of the lockdowns in China as well as in Singapore, we see that there has been a healthy recovery in the residential sales in China. Yeah, and in fact, we noticed that they have the units transacted have actually maintained their pre-COVID prices. Lastly, as a experienced real estate player, CapitaLand is actually quick to pivot and capture the changing trends in the real estate space. So the digitalization of their retail business is one example, as well as the preemptive merger of CapitaLand Mall as well as CapitaLand Commercial Trust to capture the changing trends from the URA's master plan which are geared towards integrated development. So these are some of the examples of how CapitaLand is actually quick to pivot. So our call on CapitaLand is a buy. CapitaLand is actually trading at about 40% discount to their RNAV. So this is considered a relatively attractive entry. Yeah. Next slide, please. So moving on to some of our other buy and accumulate calls, we have Ascendus REIT. We have an accumulate rating on Ascendus. We like Ascendus due to the diversification of their tenant mix, and as well as because of the sheer number of assets that they have their portfolio is actually almost 12.8 billion Singapore dollars in AUM. This actually helps to reduce asset concentration risk, and actually 64% of their assets are in the more resilient asset class types. So for example, these are your high-tech, high-spec, as well as your business park and science park kind of assets. So these are the more resilient asset classes. And as mentioned, the very large tenant base, they have about 1,500 tenants. This means that actually the tenant concentration risk is largely reduced. The largest tenant, which is Singtel, actually accounts for 4% of their revenue. So the last 2 points of why we like Ascenders actually makes them very forward thinking. They are active. They have been actively redeveloping and repositioning some of their assets. So what's happened is that some of their light industrial assets, they have actually repositioned it to high-tech, high-spec assets. So this will actually allow them to command higher rents, and it actually reduces their risk to the light industrial sector, which as you know has a higher percentage of supply coming onto the market, and their willingness and ability to take positions in promising markets in a meaningful way, such as in 2018, they entered the logistics market in the UK with acquisition of almost 26 assets. So it allows, and also last year, they entered the US business park asset, sector. And so this actually allows them to show that they are in it for the long run in these countries, as well as attract the talent that is necessary to for active management of the portfolio. Yeah. So accumulate for Ascenders REIT. Next slide, please. Moving on to CapitaLand Mall Trust. So a few days ago as well, 29 September, the unit holders voted in favor of the merger between CapitaLand Mall Trust and CapitaLand Commercial Trust. So they will be merged, and moving forward, they will be traded under CICT, CapitaLand Integrated Commercial Trust. Yeah. So we believe that this merger is beneficial for both. On its own, CapitaLand Mall Trust, the enlarged REIT will have an AUM of 24 assets, AUM of $22.4 billion, which comprises, as you can see in the first graph, a very nice even mix between retail, office, and integrated developments. It's a very well balanced portfolio. So this diversified and large portfolio provides stability through the economic cycles. Potential for higher trading, as an enlarged REIT, there's a potential for higher trading liquidity and positive re-rating for the REIT, as they will be able to, they have leapfrogged to the second largest REIT in the Asia Pacific region. So this actually promotes their visibility, and it allows them to have a more competitive cost of capital. So potential synergies for the enlarged REIT will be cross-selling between asset classes, and of course the enhanced digital platform, and cost optimization from bulk procurement and supply chain optimization. Next slide, please. Moving on to Escort. So for Escort, we like them for two reasons. First of all, of course, is their diversification of lease structure as well as geography. The first pie chart here shows the diversification by lease structure. So typically, Escort has strived to maintain a 50-50 split between the stable leases, which are your master leases, and your management contract with minimum guaranteed income. These are the stable leases, as well as 50% in management contracts, which are more variable or growth leases. Okay. Also, of course, in their very large portfolio, they have a very even distribution between geographies. So why we say that defense mechanisms are kicking in the first paragraph, as I mentioned, the Escort usually maintains a 50-50% split between stable and growth leases. However, this time around, you can see that the master leases and the MCMGI actually accounts for almost 70% of gross profit for 1H. So while the management contracts, which are the variable income, they have decreased due to the lockdown measures in various countries, the master lease revenue has actually been more or less stable, and therefore accounts for a larger piece of the pie for this first half. Yeah. So apart from that, the assets are also primed to benefit from the pent-up leisure travel demands, of course, post-vaccine. And ART is able to ride on the sponsor's global footprint and increase. And this is the graph on the left actually shows the number of keys that the sponsor has and aims to grow. So basically, these number of keys under management are under the brands Ascott, Citadines, and Somerset, and also Liv, which is the newest brand. And as the sponsor grows the number of keys under management, as there are more buildings that are branded Ascott, Citadines, and Somerset, this actually helps to increase the brand awareness. And ART, as most of their assets are actually branded under these house brands as well, will benefit from this rise in prominence of the brand. Yeah. Okay. So next slide, please. For my last counter will be city development. So city development, I draw your attention to the two pie graphs here. Their revenue is largely from property development, 40%, hotels 24%, and investment property. So, and their major markets are of course Singapore, China, and UK. So we noticed that we like city development because of the and we noticed that there's healthy take-up in residential sales post-lifting of the lockdown measures. And 60% of the AUM is recurring in nature. However, the downside is actually this recurring revenue, a large portion of it is actually in hotels. So as we know, now is not a great time to hold hotels. The city development is also very avidly trying to grow the recurring revenue stream and they're doing so by acquiring more private rental assets, as well as through their fund management platform. And we like them for their avid repositioning and redevelopment of their assets, and they are unlocking value through strategic developments. For example, the picture on the left actually shows you Fuji Xerox Towers, which they will be redeveloping, and using the CBD incentive scheme, this actually allows them to untap or rather unlock 25% increase in GFA. Yeah, and they are also restructuring their recently privatized MNC corporation, Millennium and Copton Corporation, which is their hotel operation business, as well as their recently acquired Sincere Property Group. So that's all for me. I'll pass the time on to Paul.
Yeah. Oh, thanks, Natalie. We have a buy rating on Kofu, which we think is a beneficiary of the consumption recovery post-COVID-19 circuit breaker in Singapore. So in the table on the left, we provided a summary on the F&B services index in the different segments of F&B sales. And you can see the recovery in F&B sales after the circuit breaker for June and July. So the numbers for August is not out yet, but we do have the numbers for June and July, but we do expect the recovery to continue to be even stronger in August as the number of community cases, like what Paul presented in front, start to come down. So you can see that cafes, food courts, and other eating places, we provided a year-on-year change and the month-on-month change. You can see that in terms of month-to-month change, June, in terms for cafes, food courts, and other eating places, saw a 16% month-on-month change versus May, and then for July, 21.8%. Similarly, for restaurants, you see a 43.4% recovery and 61%. Overall, F&B sales increased 18.9%. On a month-on-month basis in June and 29.2%. We draw your attention to the food courts and other eating places. It's actually lumped up. So we're not able to see how each individual segment perform, but you can see for the two segments that Kofu operate in, food courts and restaurants, they actually saw the strongest growth. It is important to note that this is still a decline from last year. However, we are encouraged by the segment's overall recovery. In addition, point number 2, the TOP of the group's integrated facility, which was originally expected to complete by the third quarter of 2020, has been delayed because of the circuit breaker. But the management has now guided that this is now expected to happen in 4Q of 2020. So they expect to move into the integrated facility by likely by the first quarter of 2021. So that means that for our third point, that there is a potential special dividend, which we estimate to be about 4 Singapore cents expected from the sale of their existing central kitchen. So they are looking to distribute about 50% of their profits from the sale. Point number 4, we also see new store openings resuming. These openings were postponed in first half 2020 because of the circuit breaker, obviously. But they will resume opening in the second half of 2020. We expect to see 2 new food courts opening, 1 quick service restaurant, and 3 new R&BT kiosks open in the second half of 2020 alone. Our last point, we like Koufu for their strong cash flow generation. Koufu is a consumer business, very, very strong cash flow generation from their businesses, and they have a extremely defensive balance sheet, which will help investors tide over really this crisis at this point in time. And also we like them for their very high and respectable ROE of about 20.6% for financial year 2021. We have to conclude, we have a buy rating on Koufu with a target price of 77 cents. For our next slide on Sembcorp Industries, Sembcorp Industries, of course, completed their demerger from Sembcorp Marine last month. And we think this will lead to a potential positive re-rating of Sembcorp Industries as profitability and ROE improves from financial year 21. You can see this on the table on the left-hand side, the table at the bottom. You can see that for financial year 21, without the encumbrance of Sembcorp Marine, what we have seen is a slight reduction in debt levels, and we expect debt levels to continue to go down because you don't need to, they won't need to hold so much debt from Sembcorp Marine. But you can see profit attributable to owners of the company start to surge as well. Without the impairments, we still forecast financial year 20 to see a loss. Because of the impairments in the first half, and of course dragged down by the 9 months contribution of Marine. But with the deconsolidation of Marine, we do think there will be an uplift in terms of the profits for Sembcorp Industries, about 326 million that we expect for FY21. We also think, point number 2, we also think the IPO of Sembcorp Energy India will happen sooner rather than later. They are currently waiting for the right equity window to list. Of course, we want to be very quick to say that listing the Sembcorp Energy in India is only one of the other options. They could realize value from their Sembcorp Energy India business through a variety of different means, including a trade sale, for example. And this will crystallize the value of Sembcorp Industries India business unit, which we have an in-house estimate of about 98 billion Indian rupees, or 1.8 billion Sing dollars. So to find out what the magnitude of this 1.8 billion Sing dollars is, you can compare this with their current market cap of about 2.6 billion. So you can see how big the India business unit is. And we've also got a slide on the left-hand side for sales, net profit, and net profit margins as well, which we expect to improve from FY21. Third point, we expect an SCI focused on energy and urban without the encumbrance of Sembcorp Marine to see more stable earnings, because energy and urban is typically more stable and more defensive in terms of their earnings. So 326 million again for FY21, which is about 15 cents per share. For our last point, we pegged Sembcorp Industries to a price to book value of 0.7 times financial year 21 equity value. So how did we arrive at 0.7 times? This 0.7 times FY21 equity value is a slight discount to the historical 10-year historical average equity value, implied equity value, when we strip out the marine business. So it's about 0.8 times of their equity. Just the Sembcorp Industries group, about 0.8 times. So we peg it to 0.7 times to arrive at a rating of a target price rather of $1.75 and a buy call. I'll now hand over to Wee Kuang to cover the banking and healthcare stocks. Wee Kuang, over to you.
Okay, thank you, Terence. So our next stock buy counter is DBS, and the title explains it all. Net interest margins will likely to be compressed for a long time. And since net interest income makes up more than half of the income of the banks typically, in terms of the revenue headwind, is definitely here to stay despite the recovery in the non-interest income. There will be a recovery, but we are not likely to see income exit pre-COVID-19 levels in the near term. So provisions for the banks also will drag down earnings as the banks continue to provide allowances over the next 2 years at a credit cost guidance between 80 to 130 basis points. The possible extension of loan moratorium only makes tapering of these heightened credit costs even more unlikely due to the uncertainty once the moratorium period ends. Yep. So furthermore, we know that the banks, the cap in dividends at 60% of financial year 19 levels by the MAS also hurt the attractiveness of the banks, despite the yield hovering around 3 to 4% currently. Nevertheless, we do have an accumulate call, and we feel that the major repricing in valuation-wise will come once the moratorium ends, which will better indicate how well the banks will weather the COVID-19 crisis. So next. Yep. Next. Okay, thank you. SGX. Generally, we are positive on the growth prospects of SGX that is underpinned by the stability in their current businesses. So in 2020, since the start of the year, trading volumes for SGX was up about 40% year on year. And based on the latest data, if you take a look at the bottom left table, we see that the SDAV for the first quarter of financial year 21, which is between July to September, is up about 60%. So we don't already have the derivatives data yet, but based on equity derivatives products, it seems like the derivatives will be positive year on year in September as well. As such, for the first quarter ending in September, we believe that SGX will year on year. In terms of growth, we've also seen SGX undertake some acquisitions throughout the year, including BitFX and Scientific Beta. And the licensing agreement to replace their expiring MSCI contracts will also benefit them. As such, we see revenues to increase about 10% year on year for the financial year 2021. A small point on dividend, actually recently increased their quarterly dividend from 7.5 cents to 8 cents and will be maintained moving forward per quarter. So their yield currently will slightly improve from 3.3% to 3.5%, and we have an accumulate call with a target price of $9.45. Okay, next. Okay, so for the next counter is Hyphens Pharma. So we like their expansion plans undertaken to expand their portfolio and sales channel. So over the past 2 quarters, we've seen them acquire CG210 hair care product and also entering into a sales agreement with SUTL for the distribution of Ocean Health products to sell into Hong Kong, Macau, and duty-free China. It will continue to represent some new pockets of growth for them and support our estimates of about 10% revenue growth year on year in financial year 2020. Yep. The graph on the left actually shows the breakdown in revenues for Hyphens Pharma. And as of the first half of 2020, we see that the proprietary brand segment and medical hypermart segment have already recorded revenues more than 50% of their financial year 19 levels. So specialty pharma principles, however, the segment is near the halfway mark, but not really there yet. But I think mainly it was affected due to the circuit breaker period when there was a closure of the specialist clinics. So a lot of these supplies are not given to the special. The demand for the supplies are much lesser during that period. In the recovery stage as well. So we should see sales start to recover in the coming 2 quarters for their financial year 2020. We maintain a current buy rating, a target price of 49.5 cents for Hyphens Pharma. Next. Okay, so the last one on my list is actually IX Biopharma. We just initiated the counter yesterday. So feel free to check out the report and tune into our webinar on Monday for a more detailed presentation on the company, because we have to keep this a little bit more brief. So in brief, IX Biopharma is a drug developer with their business segments in specialty pharmaceutical products and nutraceuticals, which is like your supplements. So their novelty technology is actually not in any of the compound itself, but it's actually in the Waferix wafer technology, which allows for drugs to be delivered through the blood vessels under your tongue. So for IX, we are positive on them actually signing an out-licensing deal for their wafer mill to undertake this phase 3 of development trials that will see them being used as a treatment for moderate to severe pain. So wafer mill is a ketamine wafer. Yep, and since ketamine is already being used for pain treatment for a lot of places, we see that there is very little risk associated with the developmental trials. And this out-licensing deal will see licensing fees for them that can see the company break into profitability in financial year 2021. So this is which is between July this year to end of June next year. Second point we have is that currently in their current businesses itself, there is already a strong demand as they shift their business model towards commercialization. So we see that their sales is actually up a compounded annual growth rate of 100% year-on-year over the past 2 years. And they are planning for a 6-fold increase in production capacity by the second half of financial year 2021, which will see we will see revenues be lifted by up to 250% in the current year. So this will work around their shortage of supply experience for their current products in the market. And lastly, the Waferix technology provides a long-term potential for the company because they are not just coming up with something new that can bear a lot of risk, but by incorporating their current Waferix technology into an existing drug, it will give them a better and newer, a better product that is new to the market and is due to the patent surrounding the technology itself. As such, our initiation was a buy call with a target price of 45.5 cents. And that's it from me. Now pass the time over to Paul for the remaining of the counters.
Thanks, Bikong. So I'll just run through another 4 or 5 slides just on some of the remaining buys. Asian Pay TV, because of their big track record in dividends, usually when I talk Asian Pay TV, most people actually leave the room. So thank you for staying back. Anyway, Asian Pay TV what they do is they are a monopoly cable TV provider. So they're almost like a StarHub equivalent, but the difference is that you don't have to pay expensive content because most people just watch the local channels. So anyway, the reason we are positive is there are 2 reasons for this. So if you look at the chart on the left, so the dividends they were paying, the red line was obviously much more than whatever cash flow they were generating. I mean, everyone was happy, so there were no complaints. But of course, it wasn't sustainable, and the reason was because of the red line, the capex line. So what the authorities asked, kind of like mandated them to spend more on a second set-top box. So as a result, whatever capex they did, as you can see, even though the beige line rose, but the blue line didn't move much. So basically, they didn't get any payback from the capex. So the dividends was not sustainable, and eventually they had to cut. And you can see in 2019, the red bar just totally collapsed, and that probably the same thing for the share price. But right now, what we think is that the dividends are much more sustainable, as you can see from the blue line, partly because the capex is declining. So that is reason number 1, and we think that the 8% quarterly dividend, 8% dividend paid quarterly can sustainable. The second reason is the optionality. So although you can see that the capex is still high because they've been spending in preparation for 5G, and 5G is a high turnover, high profit business because the capex have been spent, and all you need to do is just turn on for new mobile operators. Because when 5G comes in, the license has been awarded in Taiwan. So what happens is that the operators have to use your network because there's the requirement for more bandwidth when 5G is rolled out. I'll move on to ComfortDelGro. So for ComfortDelGro, as you know, there are basically 2 reasons why we like it. As the initial chart, as you saw, when the lockdown is eased, there'll be the immediate beneficiary. And also the stock is already down 40%, and then you are getting this recovery underway. So we think that there's upside to this stock, number 1. And then number 2 is the chart on the left. So as a result of this, we see that they are grabbing, no pun intended, but they are grabbing market share, and it's a bit higher, and it's rising because some of the competitors also obviously feeling the pandemic hit impact, and also that's why their market share is actually rising. So it's not easy to find any business in Singapore at least that has at least 60% market share in taxi, and also actually 60% market share in the bus in the bus contracting business. So these are the two reasons. And what we also see is that the competition from Grab, although it's still there, but it's also easing. I think the number of private vehicle hire drivers are also coming off. Okay, the other one is more of a niche, so I won't run too much on this because probably most will not actually understand what they actually do. But what they do is they provide the consumables. So when you want to pick up a wafer buy, I know I won't go too detailed, but whenever you want to pick up any semiconductor, what they do is there's a rubber tip to help pick up these semiconductors. And the good thing is that their customers need this rubber tip. It's a consumable. So every couple of hours, 6 hours or 8 hours, you need to keep on replenishing. So you need to keep on buying from them. So long as there's volume for semiconductors, they will benefit. And they are almost like a hidden champion because they are probably some of their market share, they are a global player and their market share can be almost like 100% for some customers. The other reason why we like them is that there's a new growth driver. So they are more into this, like I said, consumables, but the US business, I think they've announced that they penetrated into a new front-end business. So you can say it's almost they're delivering semiconductor parts to the front end, something like what AEM or even UMS does, but not the whole system, but just parts. So this is a new frontier and a new growth driver. And even if you may not think it's a growth driver, you might not think that this may be material, they are actually still paying you a 5% yield as you wait for the whole semiconductor cycle to improve. But of course, the only thing is that the liquidity for this stock is a bit thin. And they are one of the highest margins out there with 55% and a 25% ROE. Next slide, Netlink. I think all of us know since most of us are customers. Again, it's just slow and stable and it's meant to be that way. Probably in the next 5-6 quarters are probably going to show you the same stuff because that's the whole purpose. It's slow and stable, and there's a regulatory protection. Whatever they spend now until 2022, they will be given they'll be allowed a return IR return pre-tax of 7%. And of course, there is still growth. I think what happens is that it will just grow along with the household formation. Of course, it won't be as high as the past because you did have 1.42 million customers. Another 25,000 not going to move the needle, but at least it will still grow. And what you want is just that 5% yield and the stability. The next one is PropNext. We like it again. We mentioned many before because they are dominant. They got 50% market share. Almost 50% market share of any new property being sold, like half of it is done by a PropNext agent, and also any new home sales or resale is also most likely going to be done by a PropNext agent. So and like I said before, in Singapore, you want to get any business got 50% market share is hard. And we also like the business model because they got ROE at 25%, and there's hardly any fixed assets in this business. It's 4 million, probably just the cost of one bungalow or probably one apartment. And to make 20 million a year. And also we like it because they are paying a yield of almost 7%, and they will continue to pay, and they want to position the stock as a dividend yield stock. And to maintain this dividend of 7%, they need like 15 million a year, but their cash in the balance sheet, the last result was 100 million. So I mean, even if nothing happens, they close the doors, they probably can still pay you this 15 million every year. I mean, they are not closing, I'm just saying if they want to close the door. Okay, Thai beverage, they were hit, I think like we mentioned, there was an alcohol ban. So the numbers are starting to pick up again for Thai beverage. Number one, that's the reason why I like it. Number two is just the valuations. I think, they are a dominant player. I think their market share in spirits is 90%. I'm not sure who's the balance 10% or how they compete, but almost all the spirits is the sugarcane spirit. It's a very unique product. I mean, just for Thailand, like a vodka, but this their unique Thai rum, sugarcane rum. So the reason why we like it is the valuations, and also there is a stimulus underway by the government. They're looking to put cash handouts and salaries. I know there was a question on the politics. I mean, obviously asking me on Thai politics is as good as asking your neighbor that reads newspaper. So what we do is I actually do talk to we have a big team in Thailand, a big research team, and I actually do talk to them. So the feedback we got from them is that the protest isn't organized enough, number one, and they have a lot of demands all over the place. And so far, the protest seems to be confined to the young. So it's not a big, of course, something to watch, but it's not a big risk that can destabilize the whole economic situation. And of course, with the government stimulus and handout, that can kind of offset any such weakness. So that is the impact of the politics. I think someone asked that question. Just the last one for me, UG. I know there are some questions, but for UG, this chart on the left is just to show you how well the exports of gloves are happening in Malaysia. I think it's 40%. I think the last number was 40% growth. So I mean, in COVID, very few industries are growing, but obviously the healthcare gloves are growing. Some of the reasons why we like it is the earnings are obviously going to jump more than 5 times. And of course, the big question now is, I think everyone is asking, is post-vaccine. Firstly, I can just tell you directly, nobody knows what is the normalized demand post-vaccine. I mean, you can guess, but nobody can tell you the right number. But do note that even before this whole COVID, glove demands were already growing 8 to 10% per year. That's number one. Number two, demand will not peak. I think because what has happened is the non-traditional users are using, I think from supermarkets to airport to airlines. So they will even use their post-COVID. And the third reason is, whenever you have such a catastrophic event, be it 9/11 or global financial crisis, what you notice is there's always increased spending, for security and so forth. So what we think is that even though post-vaccine, there will still be increased spending and increased awareness for the use of PPE. Post-vaccine, the demand might weaken a bit, but it won't collapse and it won't be like the end of all glove usage. We think after the short-term decline, things will recover. So we still have a buy on it. And recently, EPF became, EPF is the Malaysian equivalent of CPF. So they became a substantial shareholder of UG. Because UG is probably one of the cheapest glove stocks out there. I think on current year's earnings, they're probably trading at 11, 12 times PE. So even if you think their earnings not sustainable, they're probably looking at low mid-teens, which is still very attractive considering there's still growth in this industry. Okay, sorry, I know I'm rushing, and because we want to leave time for Q&A. Any of our conclusions are here. Again, after the snapback upside, the earnings we see momentum will be a bit sluggish, but the low interest rate means I think equities is still the best place to put your money. I mean, in our view, and our equity strategy is revolving around dividend yield. This is our target, but again, it all depends on the banks. Okay, I think I will try to end it now so that we get more time for Q&A. This is our research equity team. Feel free to ask any of them for questions. And of course, this is our stocks BNB. We will post all our questions. We will post some of those questions that are not answered in this website under the community page. And actually, our admin not happy that we flash this, but if you want to subscribe to our reports, feel free to use our WhatsApp because it's not easy to maintain. Because it's almost like manually done to maintain this subscribe. So, but if you do wish to get our reports via WhatsApp, just feel free to type or subscribe to this number. And yeah, I will end it for now, and I think we should just move on to Q&A because some have posed the questions very early, and sorry we have not addressed it yet, but I think we will go first to the pigeonhole. I think we will just read out the questions, and the relevant analysts will try to answer. I think we call the first one. I think will be for you on banks.
Yep. Okay. Thank you, Paul. So the first question we have on pigeonhole itself, what could be the risk factors that send banks another leg down? Suspension of dividend for a longer time, bankruptcy of big name borrowers, or something else? Okay, so generally what we see is that for the banks, it is already kind of beaten down because people are already expecting low interest rates, and they are expecting high provisions in terms of allowances, which will take weight on earnings, and they are not also very bullish on the dividends because it is already suspended until at least for the rest of the year. Then if you think about sending them another leg down, it will be something that is more unexpected, right? So for unexpected events, first of all, the one that I mentioned when I talked about DBS is that if MAS decides to extend the loan moratorium and the banks have no choice but to comply, then it might signal something in the credit quality that maybe the banks did not do enough to add on to the credit cost during this time. And secondly is if they actually extend cap in dividends. Although as of right now, there is nothing in the talks, but this is something that will definitely hurt the banks if suddenly MAS come and say, oh no, we want you to stop your dividend for another, lower your dividend for another 1 year. Then I think it will definitely take a hit on the confidence of investors when you're looking to enter the banking counters. Yep, and aside from that, I think generally everything else is quite safe. Yeah, so these two are the main key risk factors.
Yeah, and just to add on, the big call for us, for banks, I mean, correct me if I'm wrong, for Econ, is that, as you know, all the banks gave a 2-year provision. I mean, they're very aggressive in provisioning. So they gave 2 years of provisioning. So the big call for us is, when will they say, okay, I think 2 years was a bit too much. I think we kind of over-guided, we were over pessimistic on our provisions, and we need to reverse. So that will be the big call, and that will be the big turning point, we think, for banks. Because what that means is that the banks don't need to provide so much, and then MAS will say, okay, we're not going to bug you on the dividends. So that will be the big call that we need to make, right?
Yeah, correct. So yeah, aside from, yeah, definitely aside from that, once they are able to do that, you'll see their earnings start to jump already, because currently their provisionings is so much at a much higher level, like multiple times of what they have been doing so for the past few years.
Yeah, so it's just the timing, that we need to make the call. Okay, I'll move on to the next question. It's more for me. I was hoping nobody asked me this, but thank you. What will make you change your negative rating on sets? Yeah, I know we have a sell call on sets, but the thing still keeps going up. So thank you for that question. Okay, anyway, some of the reasons is that what will make me turn, basically, is because for us, it's just the closure of the borders is going to hurt the business. I think we all know that. So number one, there's basically no one flying, there's no traffic. So we think that the next few quarters earnings will still be weak, number one. Then number two, what we worry about is that is the competitive environment. I think for airlines, as you know, with all the government support, competition has not improved for airlines. So even if the vaccine is found, everything is opened up, it will still be as competitive as ever. And what this means is that the two biggest customer for sets, although they never mentioned, but I think we all know, is SIA and AirAsia. So what's going to happen when is that SIA and sets is just going to ask you for discount. I mean, they are hemorrhaging money, they're losing money. They're just going to press sets down for in terms of prices. So these are the two main worries we have on sets. So even if there's a recovery, there won't be any pricing, because the customers are losing money. It's like hardly any. The liquidity is so tight. And the third reason is that even during the good times, stats was already trading at 20 over times PE. So even if it's down 40%, if it recovers, it's still a very expensive stock for us. So that's why we prefer Comfort, because we can see the recovery. The recovery is already happening, and we don't have to worry about the border closures. Of course, maybe there'll be less tourists traveling to Orchard, so maybe there'll be less taxi in that sense, but we can see the recovery underway for Comfort. So I mean, that's the reason why we had a call on Comfort and not on sets. I hope that answers your question, and I hope nobody asked so many difficult questions. But I'll move on to the third one for Wee Kwang on banking.
Yep, okay. The third question is whether digital banking will steal the market share of, I'm assuming, the current banks, right? Okay, so what we need to we need to put everything into context that, yes, definitely the new entrants will definitely be a threat to the current banks. But then when you look at it, the banks have already started moving digitally since, I don't know, 2-3 years ago. And then you can see the investment that they're making into building their digital platforms is so much higher. And this is like building a runway between them and the new entrants. So the new entrants, they can't start operating yet. So they can't even like see what are the problems, what are challenges that they might face when they enter the market. So unless they are able to provide something so niche that the current banks are unable to do so, which we are doubting, because right now the banks are doing all they can. Of course, they are monitoring the market as well. They are not just sitting back and like, oh, wait until they come and then we react. They are already very active in trying to see what are the challenges that they might face from these new banks. And generally, when MAS approves these new digital banking licenses, they want the new bank entrants to be on the safe side. They're not trying to. So you'll be hard for them to undertake very disruptive activities such as price competition, for example. So in a sense, the real impact from a digital bank will probably come in 2-3 years down the road when they start to mature. Yeah, even so, 2-3 years is a very very optimistic to say that they will be able to compete on an even level compared to the local banks.
I think we move on. Next question before Terence.
Okay, so I'll just read out the question for the benefit of the audience. We have one question. How is the bubble tea and Macau food court business doing for Koufu? What are the growth drivers for Koufu? And what do you see as a fair valuation considering the limited size of the SG Singapore food F&B market? So, so there are three questions here essentially. So I'll answer the first one. How is the bubble tea and Macau food court business doing for Koufu? So the overall, based on the first half and full year 2019, their full year 2019 results, the Macau business is only about 6 to 7% of their in terms of total revenue contribution for the group. So it's still very, very small. In terms of how it's done, I guess during this COVID period, it's actually performed worse than Singapore in terms of recovery. So in Singapore, we are looking at about 60 to 65% average takings for improvement from pre-COVID levels. So it is recovered to about there. And then we see for Macau is about 40-45% because of border lockdowns in Macau. So it's a lot slower in Macau. But again, like I say, because it's such a small business segment, so the impact is still not as large versus the recovery in Singapore, which is actually a more important aspect. Second question, what are the growth drivers for Koufu? So for us, we see Koufu expanding a lot out of the traditional food courts. They've gone into the restaurant segment through their Element restaurants, and then also their R&BT, which they've ramped up very rapidly over the last couple of years. So even as they diversify their revenue sources and grow their revenue sources, not just from their traditional coffee shops, this we think will give them a more diversified income stream. Second point that we make is that we mentioned also earlier in the slides is that the launch of their integrated facility is expected to be a key driver for them, because what that does is that they're currently operating in two central kitchens in Woodlands Avenue, and what happened is that when they moved to the central kitchen, they actually merged this. So we expect to see substantial economies of scale from a cost perspective. So that will give them a cost advantage, especially in such a competitive business. And of course, their ROE has also been very respectable. So those are what we think as the drivers for Koufu going forward. And then expansion. The third point is expansion overseas. They've just opened new outlets in Southeast Asia, and of course they're going to expand in Macau as well. I don't want to take too much time, so I'll go to the last question. What do you see as a fair valuation considering the limited size? Again, obviously they are very concentrated in the Singapore market right now, but they are definitely expanding and also into different segments. So based on our initiation on Koufu, we pegged it to about 12 to 13 times financial year 21 PE. Okay, yeah, that's all from me. I think the next question is for Paul.
Yeah, okay, thanks, Terence. I'll move on to the next question. I'll read it out. Some of the parts analysis finds that market is valuing Singtel at negative value minus its listed associates. Actually, it's not. But then, do you feel it is undervalued and catalyst of inflection points to watch? So to give you a flavor, you know, my valuation for Singtel was about 244, I think. And the sum of parts of the listed associates. For those who don't know, you know, the Singtel owns the AIS. They own Telco. Telkomsel is not really listed, but it's through Telcom, and then they own, of course, Bharti Airtel. So the sum of parts, the market value on Globe Telecom. So the market value of all this is roughly only about 20+% of the whole 244. The rest of it is, you know, EV/EBITDA of the Australia. Australia is actually even bigger than Singapore business. So the answer, no, I mean, the Singtel business is not a negative value to the associates, number one. Do you feel it's undervalued? No, it's not undervalued. And do you feel and the catalyst or inflection points to watch? Okay, the thing to watch for Singtel is Australia. I think many may not notice, but actually Australian profits actually down 60 to 70% year on year. The thing is that because of the NBN, you know, the fiber the fiber business basically being surrendered back to the government. So of course the government got to compensate you. So the government compensates you. So the numbers don't look so. The numbers look still holding steady right now because of the NBN compensation. But once this thing is over, then you will see that the earnings will even drop even further. So basically, for us, we would prefer StarHub than Singtel. I think Singtel, even if the borders open again, you know, StarHub will benefit, and then you don't have to worry about the whole problem in the whole issues with Optus right now with the whole NBN business, because they will still, like I said, be burdened with having two networks. They have to have costs to manage the government network, and also costs on the existing network. So Singtel will be not say problematic, but will not be something will be interesting for at least the next, I don't know, 1 year or so. I mean, in our opinion. Okay. Anyway, I'll move on to the next question. I think it's as for you on Sembcorp Industries.
Yeah, thanks, Paul. The next question on Sembcorp Industries. Sembcorp Industries utility business has been less than stable in past years. No long-term PPA in India, liberalization of electricity market in Singapore, and write down on UK acquisitions. What will change for ROE increase? So you're absolutely right. Sorry, let's go back to the question. You're absolutely right. The energy business for Sembcorp Industries, we've seen volatility in that. We've seen some write-downs in the UK as well. No long-term PPAs for their Indian business as well. That's correct. So, but what we have seen is that for in terms of the Indian business, we've seen them take up the plant load factors start to improve. I think they're working on getting more long-term PPA. They understand that relying on just the spot rates alone can be a little bit more volatile. So they're working on longer-term PPA agreements. But what's really behind the reason for the call? I think when you compare Sembcorp Industries' historical earnings with the Sembcorp Marine Group, and then compare Sembcorp Industries going forward without the Sembcorp Industries Group, is an easy recovery, simply because the marine business, like what my colleague Paul mentioned earlier on in his presentation, because the marine business has been hit so badly. So just the deconsolidation of the Sembcorp Marine Group alone can already lead to an uplift of the whole entire Sembcorp Industries Group, even if the rest of the businesses remain stable without any change. Okay, yeah, so I'll just leave it there.
Yeah, anyway, let me just quickly take one or two questions from the group, from the other chat, because I think there were more than 38 people voting for us. So let me just quickly run through one or two questions before we go back to the pigeonhole. Anyway, let me read out from the Zoom Q&A. Which sectors will be the early winners once a vaccine is successful? Any stocks to recommend? Sorry to keep everyone waiting. I know this question was there, but anyway, from our view, if there is a vaccine announced tomorrow, what shares will pop up the most? It obviously will be the hospitality, the airlines, and the person who asked me the difficult SATS question, and also SATS. So these will be the obvious winners. I mean, immediately once you get a vaccine, you know what it means is that the borders are opening. So all those stocks that have been hurt the most will be the beneficiary. But again, this will be the initial trade. Then the things will kind of there'll be some consolidation, because then you take time for all these things to unravel, because vaccine found doesn't mean vaccination is underway. So even if there's a vaccine found, the vaccination could take another year maybe to kind of undergo. I think I don't want to go too detail, but you know, some of these vaccines need a lot of cold storage facilities. Some of them you need to, I mean, the mRNA, I think you need it like -20 degrees, something like that. So vaccine is found, but it doesn't mean vaccination is done yet. So, but there will be an initial pop. I mean, just to mention, all the airline, hotel stocks, hospitality stocks will get that the initial ramp in share price. I'll move on to the next one before we go back to the pigeon. What are your views about glove-based business such as Riverstone, UG, Healthcare? Is it a buy, hold, or sell recommendation? Okay, this one is a bit tricky because operationally these guys are going to do. I think the earnings is going to. I think UG and probably Riverstone earnings might probably surprise the market. But my worry is just the price action. I think with the whole vaccine news around the corner, the market is very hesitant to buy into this stock. I think it's better if the vaccine is just announced, then the stock, I don't know, maybe my correct bit, then as the operating results come out, then I think the path will be better. So near term, I think the results should be good, and there should still be a trade on up to the results. But what hesitates me is all this news flow on vaccine, and it will cause a lot of investors to be nervous. But operationally, I can tell you it is really good, and prices for rubber gloves continue to rise even into October, November. But just that may not be enough for the market. So that's my only concern. Yeah, I'll move back on to the pigeonhole questions. Yeah, because since so many people were asking on these questions, I thought I'd try to address it. So we'll try to move back to the pigeonhole questions. Oh, okay. Anyway, it's a comfort question. You say Comfort Delgro is a tactical trade. What are the long-term risks if one holds, and what is the price of event that will trigger you to exit the trade? Okay. Anyway, I wouldn't say obvious, but you know that since COVID hit, the stock is down 40%. So even if you claw back, even if let's say earnings go back to pre-COVID, you can, theoretically you can see the upside because it was down 40%, right? So even if it claws back and the recovery is underway, so that's number one. The long-term risk for me is basically Grab. I think the threat from private vehicle hire is still there. But one thing near-term positive is that, as you know, there's a new rule. I've forgotten the name of the legislation, but what it means is that right now, all the comfort drivers cannot go into Grab. But with this new regulation, all the comfort drivers, the Grab must basically open up their app to all the comfort drivers. So in a short term, that is also another positive for them. But the near term, I worry is just the threat from Grab. They just got another round of funding, so that will be, and the number of taxi continue to decline. So that's my only worry in the longer term. But apart from that, the next couple of months, I think it will do well. Once you hit the target price, maybe that's the time to exit. Anyway, I'll move on to the next question. I think it's more for Natalie. Thanks.
Okay. Hi. So the next question is about the merger between CMT and CCT to form CICT. Would it make it a more investment candidate over FCT? And what is the CICT's actionable acquisition pipeline? Okay, so for, I think CICT, which is the new enlarged REIT, will be different compared to FCT. So FCT, of course, is more resilient and recurring necessity spending. So I think that gives it a bit more stability. So that's one reason why we like FCT. Whereas CICT, I think someone else mentioned that yes, CMT, or rather the enlarged REIT CICT Moody's has downgraded the outlook to negative. This is factoring in the enlarged REIT already, that means the merger. So I think from that perspective, it is more of while we do see there are merits for the merger, and while we do see that this diversified platform is actually more resilient, in a sense, it is still because it's a commercial as well as a retail asset classes. It definitely will be more cyclical in a sense. So I guess there will be upsides, there will be synergies, cost synergies, cost saving synergies, as well as opportunities for them to actually enhance their assets or add value to their assets through. But there will be also, of course, a higher risk factor there. Yeah, so it really depends on your, I think, risk appetite, on whether or not you prefer something that is more stable. So that's FCT for you, and whether you want something that has more of a variable upside in a sense. And in terms of actionable acquisition pipeline, I think that both the REITs actually currently do not have any ROFRs, but then the acquisition will come from like third party or actually redevelopments or AEIs, asset enhancement initiatives within their portfolio to make it perhaps a more integrated, in a sense, more retail component or more commercial component. Yeah, so that's my answer to this question. The second question, the next question, sorry, is also for me. Why capital land and not city development in the absolute 10? City development has a catalyst in the form of redevelopment of existing properties. Actually, capital land also has this, especially in their business park or science park assets in the Jurong area. And also, city development has a potential REIT listing. So this REIT listing, for the benefit of everyone, is actually a likely listing of a UK commercial assets. Yeah, and what are your thoughts? So I guess for the absolute 10, the reason why we included capital land and not city development is because of the higher proportion of recurring revenues. We like this because this gives more stability for the counter. Capital land's development portfolio in the property development segment, which is your residential sales, is actually lower. So this property development sector is the one that is causing the cyclicity or the lumpy revenue recognition. Yeah, so basically, we just feel that capital land is a stronger platform in a sense. And there are also opportunities for capital land to redevelop assets, as mentioned, Science Park and the Jurong area. And even within the REITs itself, they have been very actively recycling the capital, be it through divestments or repositioning. We have seen this from Ascot, we have seen this from REIT, yeah, as well as the redevelopments for Capital Spring from CCT and Funan CMT. So these are some of the reasons why we prefer capital land over city development. So I hope that answers your question. The next question is for Paul on Thai beverage.
Thanks, Natalie. I will, before I go to Thai beverage question, let me just answer one more question on the Zoom. Since so many people kind of voted for it, what is your view on the prospects of Keppel, which is down by 25%? Any silver lining? I mean, firstly, we don't cover Keppel Corp, but I do like Keppel Corp. I think, firstly, they don't have to have sleepless nights because they don't own any hotels, they don't own any malls, so at least they can sleep well with their property portfolio. That's number one. Then number two, they have China, and China is doing well. And number three, they got data centers. I'm not sure why they bought M1, so that one's a question mark for me. But I think they've got a very good suite of business, and what is pulling them down is, of course, the initial reaction that the partial the offer by Temasek was removed, and also the marine business the marine business is almost like a black hole. They can pull everything down. But because of what happened to Sembcorp, there is at least there is optionality on it. They can do a Sembcorp, maybe not now, because after all, Sembcorp Marine share price just collapsed, so maybe they won't do it right now. But we know that there is a way to exit out of there is a big re-rating catalyst that could happen for Keppel Corp. So my own view, I know we don't cover, but we just think that they are in actually quite a lot of very good businesses, but just that the black hole in marine just pulls everything down. I hope that helps you. And yeah, I'll move on to Thai beverage. The question is, why is Thai beverage trading at a big discount to peers, and what are the possible catalysts? I think it's partly trading to peers. I think just that the earnings is quite lackluster. Earnings is lackluster because I know you don't see America tell everyone, hey, shut down 1 month, no alcohol consumption. So that happened in Thailand. Although initially I didn't believe they would enforce it, but so that happened in Thailand. So obviously that hurts earnings in the near term, number one. And then number two, in Sabeco also hit by regulations. I was also surprised, but I think if you are on a bicycle and you have alcohol in your breath, I think they're going to fine you too. I again never thought it would be so severe. So that is the two reasons why the earnings will be flat. Just that the spirits business will rebound, and it's like 90% of business. So I think that's one of the reasons. And of course, after they make the acquisition of Sabeco, there's no contribution because the interest expense, whatever profit they recognize, just get eaten up by the interest expense. And of course, the leverage. So I think that's some of the reasons why Thai Beverage is trading at a discount. The possible catalyst, we like the stock, but the in terms of a big re-rating is the regulation in the operation in Sabeco need to improve. But I think that will take some time. I think the enforcement by all these drink driving rules is quite tight. So in terms of a big jump, big spike, I think it will take some time. It will just be a gradual improvement and a steady state recovery, because spirits is like a must-have drink, I guess. A Thai rum is like a must-have drink. Yeah, so I think, and they have a good business there. So I think for me, it's just the re-rating is mainly a bit on the valuation side. Operationally, my view is just a bit slow. It will be a bit slower than compared to the past. Okay, sorry, it's a long answer to a short question. Anyway, I'll move on to the next one. We'll take, I know time is running up. Let's take another 2-3 more questions. And what we'll do is we will, I know there are probably 100 more questions. This time round, not like the previous, we will try to answer them and we will post it in our community page, as you can see from this slide here. We will try to post it and hopefully everyone can get their answers there. And we'll find a way to try to organize it so that you can actually get to find the answers to your questions. So we will try to answer everyone's questions. I'll move on to you, Natalie. So we just take another 2 or 3 more.
Okay, sorry.
I think the next one is mine. I think, okay. Well, the next one is also mine. What is the impact of political uncertainty and protests on Thai? I think I've already answered that. We asked our Thai team, and it's not as severe as what maybe foreigners perceive it to be. But again, it's something to monitor whether it actually impacts the economy. Okay, I'll move on. Which are the Singapore blue chip stocks undervalued and will provide strong dividend income now? Thanks. Yeah, I'm not sure what you mean by blue chips, but for us, I think, from my perspective at least, the most compelling stock with yield now is really what Natalie and Jay Hui said, these US REITs listed. I mean, they're giving you 8% yield and US dollar. Of course, you might say, oh, there's US dollar risk, but it's still US dollar. It's still a US dollar 8% yield. So for us, in terms of yield, the most compelling would be the Manulife and Prime REIT. And like all the stats, they got longer yield. I'm not sure why the Singapore ones are trading at 4% dividend yield. Some of these are leasehold properties, whereas the US ones are freehold. They got longer yield, and they're also Class A buildings. But again, this is just my views. Okay. The next one is, do you see Keppel Corp as a buy with its capital recycling? I think we answered, we don't cover, so I'll answer. I think another one is Comfort Delgro. I think we will skip that. I think we will move a lot of these we don't cover, like straight trading. I think we will move to we just take another two more questions from the Zoom. Okay, will gold price, some of these are technical questions, so I think maybe you should ask our technical chartist. Will gold price continue its uptrend above 2,000? All I can say is, if you want simple way to think about gold is, just think of gold like a zero coupon bond. So what will move a zero coupon means a bond that doesn't pay any interest. Just so you can think of it. So anytime interest rates go down, go negative, then that's why gold price will do well. Okay. Why is Singtel underperforming? I think we answered that. What are your views on Tesla? I think you can also ask that with our US analyst who will be presenting later. I think you can ask him that. Okay. I think we probably need to end it. It's already 11:45. We didn't answer because some of these questions are the same, and some like dairy farm we don't cover. So I think we will take all your questions and we will try to post it on the community page. And we are really sorry and really apologize. We cannot take all because there's 100 over, and some we don't even cover, and some are technical questions. So anyway, we'd like to thank every one of you, each and every one of you, for attending here today. There is a recording in YouTube, and feel free to listen in if you want to. And also, again, we hope to see you soon in our weekly webinars and also in our quarterly webinars.
Okay, thank